Good morning and welcome to our board meeting today. We have a few topics. We're going to begin the morning focused on two aspects of the conceptual framework, specifically measurements and elements, and then we're going to turn our attention to our project associated with the transfer from LIBOR to SOFR. Before we get started, I'd like to welcome students from Marist College. I understand from my fellow board member you are the Red Foxes. Is that right? Good job, Gary. Way to go. He said his son used to row against your is that right? Okay, good. Anyway, welcome. Hopefully a good morning. With that, I'll turn the attention over to the staff to talk about the conceptual framework, specifically the measurement aspects. Nick?
Thanks, Russ. So memo 48 for the board. This is a memo that is seeking, the board is seeking, or the staff, excuse me, is seeking to issue an invitation to comment on the measurement chapter of the conceptual framework. The invitation to comment in this case would be a staff document. There wouldn't be any necessarily any preliminary views in the document. Typically, invitations to comment are issued for earlier stages of projects, and although we've had a number of conversations about measurement, for the most part, we don't have too many board decisions on this topic, and thought in terms of expanding the conversation, getting more people kind of to see what the issues are, understand some of the alternatives and things that the staff and the board has been discussing over the years, that it might be beneficial for the work that we intend to do to issue this invitation to comment. So again, to expand the conversation, to give people something to actually talk about. We have talked to folks on these issues, but they don't usually have a lot in front of them, and so folks thinking on these topics aren't terribly informed, or they haven't thought about a number of different points of view. Finally, another benefit from our perspective of issuing the invitation to comment would be to actually get a lot of the thoughts down about all the aspects of measurement, because oftentimes we have conversations about measurement in one particular corner of the accounting universe, and the question is always, well, what about other parts of the chapter? What will that look like? So we just thought it might be really beneficial to the work that we want to do. So with that, we did have 3 questions for the board, and we have talked to board members about some of their ideas about post-issuance outreach and other groups that we might talk to. But do board members have any views about the issuance of the ITC and any other comments about outreach that the staff has planned?
So Nick, I just have a question. When I read paragraph 8, and this is in the board memo, it says the primary users of financial statements make decisions about whether to provide their resources either in the form of investment or credit. The staff believes that how one goes about the decision-making process can differ. Different approaches to decision-making may be better served by different measures for the same type of asset. So one of my questions is an objective of the ITC to get input on what those different approaches to decision-making are, or is the purpose of the ITC to get feedback on different approaches to a concept statement, which we've talked about before, whether it should be, approach A or approach B in terms of providing, conceptual principles as opposed to providing a thought process and so forth. So what is the staff envisioning for the invitation to comment with respect to those 2 different aspects?
I think it's primarily the latter, but I think by virtue of answering those questions, you're going to get information probably about the first part, right? In saying, how would this chapter discuss the board making choices about measurement? I think the feedback that we would receive would obviously kind of provide us some of those ideas, but I think the chapter itself, when it's ultimately done, should probably focus more on that latter question. So, but I think to get constituent feedback from what we envision to be a neutral document, and lay out a whole host of things that we've been discussing, you're probably going to get feedback on the first. But I still think the document ultimately ends up more like answering the questions about the latter point.
Okay.
Said a little differently, how they feel about the alternative concepts will be informed by how they use the financial information.
Or,
Well-
go ahead, sorry.
Can you, so Nick, can you just articulate for me then, just sort of what, at this point, you have in mind for these different approaches that we would be trying to get feedback on?
Well, I think some of them we've discussed, right? So you could have a concepts chapter that would lay out, there's a dividing line between two types of measures, and assets of certain types go one way or the other, or liabilities of certain types go one way or the other. It could be a more open-ended approach where we would discuss the relevance of information and what it does for you, and for lack, this isn't terribly technical, but flipping back and forth, right, between, you might view it one way or the other depending on how you're viewing or how you're using the information. And so laying all that out and saying, so what are your thoughts? And I don't know exactly how the questions will be phrased around those, whether we'll divide that particular section into 2 or 3 sections, give different lanes and say, what do you think about these approaches? I'm not sure exactly if that's the way it's going to look, but it could. But really, I think it's more the why and how each one of those approaches would be, whether or not folks view those as useful and why not would be really the useful feedback for us.
Okay, and so then in that second approach, is what you're envisioning something that is closer to what the ISB ultimately did in terms of how they laid out their measurement chapter, or not?
So I think that definitely has to be discussed. In particular, and I think it's in part 2 as I wrote it here. I think something has to reference that. I think that's one of the things we'd like discussed in an invitation to comment, is that type of approach. But there are other approaches as well, such as laying out and saying one set of assets go one way, one set goes the other.
Okay.
Potentially.
Okay, so would the staff then envision this invitation to comment also seeking feedback on whether we should have a converged measurement chapter or not?
I think that has. I mean, again, we haven't drafted it, but
Right.
I'd be interested in asking that question.
Mm-hmm.
I think that question should probably be asked. And again, part of our outreach that we want to do is certainly talking to international standard setters and see what they think about some of the ideas. I mean, if we put ideas that differ from what the ISB's done on paper and folks say that's a terrible idea, you should just do this, and then we'll bring that to the board as the feedback that we receive.
Mm-hmm.
But that's potentially a good question to be asked.
Mm-hmm.
Christine, I think your question's sort of a style question. And I don't know how you converge around this concept statement that's not definitive.
Well, but that,
ISB's
yeah, but that,
conclusions are-
yeah, sorry, Jim, but that sounds to me, that's why I was asking my first question about the approach to concepts. Is it that we're trying to get feedback from constituents as to whether the concept statement on measurement should be definitive or should not be definitive? And when I think what I'm hearing, and correct me if I'm wrong, is that the reason why we're doing this invitation to comment is to get feedback on whether it should be definitive or not definitive. If it's not definitive, then I think that raises more the question of, well, if we're not definitive and they're not definitive, should we be not definitive in the same or different ways, right?
You could do that very easily, but I would have answered slightly differently. You guys told us you did not want to be definitive about measurement. You wanted it to be more descriptive, more a tool for you to be aided in decision-making when you hit standard-setting issues.
Okay, so
Accepted that.
if we've accepted that,
Don't know exactly how to do that without some help more broadly than talking to the 7 of you.
okay, so now it sounds to me like what you're saying is that the purpose of the invitation to comment is not to get feedback on the approach between the concept statement, but to actually get feedback on, back to question 8, the staff believes that how one goes about the decision-making process can differ. Different approaches to decision-making may be better served by measures for the same type of assets and these different approaches to
We
decision
would
making.
hope we wouldn't lead them to any particular response. And if someone wants to say to us, no matter what we put in an invitation to comment, doggone it, you guys, we want a list of every asset and liability. We want you to tell you how to measure it. And that's what we think, sir. We ought to listen to that. And we can't stop them from saying that, even though you already said that's not what you prefer. But we can't direct what people would say.
I'm just trying to understand what we're trying to get, what our objective
So I
is.
think, maybe I can describe what I think a typical objective of invitation to comment is, and it's similar to what we did on the goodwill, where we talk and try to do it as neutral as we can about the potential paths towards completion of the project, or in this case, the path towards the next step, which would be an exposure draft. So there are views out there that we would be definitive and we would have one measurement attribute for all types of assets. There's other paths that say we want different measurement attributes for similar assets that are managed differently. And there's another path that says, here are the factors the board members should consider on a case-by-case basis. And that's kind of what I think the ISB has done. Those are the kinds of things that you go and you have a discussion, and this is designed to engage our stakeholders in those discussions. So, and since it's a staff document, we don't actually signal which one the board at this time would prefer. That's ultimately the objective in ITC, and I think that's what you're ultimately going to do, and we need to see the words. But if something like that, would that be okay from a broad-based objective standpoint?
That would be fine. It's just my concern was that it wasn't clear to me when I was reading the document what you just said, and when we discussed it in the small group meeting, it wasn't clear. Okay, so that's why I felt like before I could say whether I support it or not, I need to understand what we're
But
trying
as far
to
as the way I described, that's kind of in bounds of what your vision was.
Yeah, I think the disclosure framework invitation to comment kind of set up very broad parameters and then kind of walked from one side to the other, just so people would understand where you could go. And then, constituents really helped us kind of narrow the field of which direction to go. And I think you have to have a neutral document and invite comment, have that kind of broad.
To Jim's lasering point, if we just went out with, here are all the tools you should consider, there will be some stakeholders that go, you actually should do it this way. And so if we know some stakeholders has views A's, views B's, and we've considered all this, we ought to put that out as a way to facilitate the discussion. And I can see, I know we'll get to next steps, but why don't, let's just talk about.
Okay, so I'm okay with that part. So then now with that understanding, I have a couple of concerns about going forward to an ITC, which we talked about in my small group meeting, so I'll just share with the rest of the board at this point. So one of the concerns that I have is that in order to provide that definitive, here's, one alternative for measurement, here's another alternative for measurement, that should all derive from the objective of financial reporting, right? I mean, we say in OB1 that all aspects of the conceptual framework, including measurement principles, should flow logically from the objective. So it would seem that we're going to need to be quite clear about what the objective of financial reporting is. And yet, when I go back to Board Memo number 46 that we discussed in June after all of the staff went out and talked to the board members, there didn't appear to be a common understanding of the objective of financial, or a common interpretation of the objective of financial reporting among board members or among staff. So in this memo, we talked about how one board member would say that resource allocation decisions, providing information to help, there is the objective of financial reporting, that another board member stated that the stewardship objective, particularly discussion of foregone opportunities, might not be suitable for the proposed measurement chapter. Another board member felt that that stewardship objective part was critical, okay, and those have very different implications for measurement. So how are we going to put together a logical development of the ideas that we have when we within this organization don't seem to have a common interpretation of the thing that we said the measurement principle should flow logically from? So I guess my request would be, I feel like we need to get that settled before we go forward.
So,
So you're
How-
basically talking about the difference between what some people view as the objective and other people view as the objective.
Yeah. And since it's all supposed to flow from the objective, it
I thought
seemed...
we had dealt with that at a prior board meeting. And
No, we didn't. This actually summarizes, so what do you think the objective is?
What's stated, which is how users are going to consume the information,
For what purpose, though? For,
how they're going to, their capital. But I mean,
okay,
I
for
thought-
resource allocation
We
decisions.
did talk about this at
No, I
another
know.
meeting. It was
We
2
did.
years ago. The board voted 6-0 at the time. There was one board member absent, not to reconsider the objective of financial reporting. But, and I have no problems moving forward with this as an ITC. I suspect many of us don't. I think it's a staff document. It's been a challenging area. I think the staff could move forward on financial reporting. If we want to take a step back, reconsider the fundamental nature of this
Yeah.
project, I would suggest we do that at a different meeting where we're prepared to have that discussion, including whether or not the board want to add to the project, take away from the project, any aspects of that project, and have a more fulsome agenda decision. But
So,
otherwise, I don't see what the problem with the staff moving forward, as they've suggested, on useful work to help prepare them for a better discussion for us.
okay, and my concern is I feel that we're not ready to go to an ITC, and I'm afraid it is going to be premature because of these sort of fundamental issues that we were still debating back in June of this year. So,
what do you feel needs to be debated before you can be comfortable moving towards an ITC?
I think we need to understand why there are two board members in the last discussion that indicated that they didn't think stewardship should be a standalone objective on which to have measurement principles derived, versus the one that said that they felt that it should, versus I don't even know what the other four think. Okay, and the problem is that the concept statement is not clear, and that's why there's this sort of different interpretation.
So that was the previous vote of whether we wanted to reconsider that. I think that's a request, and if that is, and there's a process, I don't know what the process actually for board members continuing to ask for reconsideration of debated issues, but if it is, we ought to do that in a more formal way. It was resolved. I understand that it wasn't resolved necessarily to everyone's satisfaction, but I'm not sure why we would then go back. I think the board at the time agreed that they all support the objective of financial reporting as stated.
Okay, well, so you know my position.
Thanks, Russ. Same paragraph, last sentence. If the ITC did nothing else except this last sentence, which basically says staff believes the differing approaches to decision-making would result in a chapter on measurement that discusses the relevance of different measurement methods in the context of different users' points of view. That's a great sentence. If the ITC did nothing but this, I would think it would be worth the effort. But I have a few questions on the staff's approach with the ITC, how this chapter will be structured, what will you do to get all those differing perspectives. And my first question is, there are a wide range of perspectives in terms of users. You can pick up the journal almost any single day and see a discussion about the shift from active to passive, fundamentalist to quants, a lot of change going on in the industry today. Will you weight one perspective over another, or how will you capture that? In effect, it's a moving target in terms of who the users are, and more importantly, it's a moving target in terms of what they find decision useful. It's moving in terms of the types of investors are out there and how they're making decisions. And I think it's also moving because you use different information at different points in the cycle. So I'm wondering how you're going to capture that array of differing decision processes in this ITC. And I know I just asked you a really big question.
Sure.
And if you need to think about it some more, great. But I'm intrigued by this one sentence, if nothing else, and how voluminous of a task that one sentence really presents to you.
So, again, from active to passive, I mean, if you're not using financial statements, then I'm not going to weight you at all. You have to be using financial statements.
And you're
so-
right. And if you're just a market weighting
Right.
mechanism, let's put those on the side for a moment.
Right.
But there are degrees to which you're using financial information.
Right.
You're not maybe picking up and reading everything, but you're picking up revenues, or you're picking up a particular expense and using that in your quantitative analysis. So
Sure.
do we include those? How do we weight that in the process?
So I think what you're asking me is exactly why we want to invite comment,
Mm-hmm. Yeah.
because I want to hear what folks believe or think the relevance of the information is, and what we perceive where we sit, right? We want to get that down on paper and invite that kind of comment. Now, does that mean that 5 years later the same person wouldn't answer the same question differently? Perhaps, but we just need that starting point to at least have an idea of what folks are thinking and why information about certain assets or liabilities measured at different ways helps them make decisions.
Okay.
That's what we have to.
I encourage you to have a really robust section on this,
Mhm.
and I think we're going to need to capture kind of what's going on in the marketplace. And I don't know to what extent you include that in the ITC, or that comes through in other research that you're doing. But I think that's going to be a really critical piece of it. And I'd also be interested in, and I know this was debated back in the early 1970s, about having a dual balance sheet, dual income statement, fair value and cost, with the thought process that both pieces of information are always relevant. They're relevant in different ways, and investors will make the decision in terms of how to weight that. And I don't know if we are contemplating bringing that debate back. Come on, Jim.
It's not contemplated up front, that's for darn sure.
No,
If someone wants to, again, if
I understand
you
that,
have a
but this is,
reasonably open invitation,
I'm just pointing
you're
out
going to
this.
hear things.
This is not the first time we've had this debate. I can remember reading, studies about the 1971 debate on this issue and why it was shut down and why we ended up with a mixed attribution model, and the pros and cons of that as well. So I'm hoping we can at least at a minimum touch on that and cite the fact that this is not the first time we've had this debate. And we keep trying to solve it by having one size fits all, and that likely will end up in a solution that satisfies very few.
I've always, perhaps incorrectly actually, all these years, it's not to me a heck of a lot different than what you people have to weigh every day, and we always have, that we know the interests of some users are forget their technique is different for arriving at their decisions, but their interests are completely different. And you guys every day on issues have to balance maybe very strict needs of creditors as opposed to equity investors or other people, their general purpose financial statements. It's a balancing act. And all we'd like to do is have a better framework for making decisions about the balancing you need to do with respect to measurement. If we can do that, we'd be successful.
I agreed, but I just don't want to have a paper that comes back and says they're mixed views. Good luck, board. Good luck. And I think we have a real opportunity here, particularly given how much change is going on in the marketplace and how decision processes are changing in a more dramatic form than maybe in any point in the last 40 or 50 years. So I think that this is a great opportunity. Support the effort, but I just want to make sure you've got that focus or that thought process in mind.
Jim?
So I think it could be useful to talk about in selection of measurement. The board has narrowed it to one because we have a single attribute model in the past, and asked the question, I mean, if we're going to continue to do that, then we ought to have, tools or lists or whatever. I mean, you could have the question in there and say one alternative is we don't have to select between one, and we can just ask that question on input of, hey, are we actually thinking about this the wrong way? I'd be interested at least in that feedback, or maybe some will say, well, you should have 2 income statements, you have 2 balance sheets, you should have.
Jim, I just wanted to point out, that decision to go with a mixed model was made when computers were virtually unheard of in terms of investing.
No, I agree.
Okay.
I did want to comment on the ISB approach, again, whether it has to be directly described in there or at least some type of discussion about. They've taken an approach that is less prescriptive and is more of a tool. I think that's what the majority, I wasn't in all the small group meetings. I think that would be useful to me, but I want to get the feedback. Others might think it's less useful, but at least describing that, and that could go along with Hal's idea of, that's one end of the spectrum. Another is you need this tool less if you have either prescriptive, all assets are this or all assets are that, or you don't limit yourself to one.
So I'm supportive of an ITC. In particular, I'm thinking about how this can be useful for the board, and certainly we've spent many years, well before I was a board member, in discussing measurement and trying to come up with a common outcome. And so I am interested in seeing if we can develop something that would be more of a tool or a framework for us to use. In terms of the outreach, I think somewhere in the memo you talked about outreach or plans for outreach. One idea that I thought would be useful is for, every year we have this annual academic conference where there are many academics that attend that conference that I'll call them long-standing attendees. I think it would be useful to tap that group as a resource for us in developing this framework, in addition to the academic resource group. That goes without saying, of course. But I am supportive.
Marcia?
Overall, I'm supportive of the invitation to comment, and I'm interested in the feedback we receive. However, I shared this in the small group meeting. I have some reservations about whether we're going to get what I would call a balanced response in the invitation to comment. And what I mean by balanced is not a vote count of who takes one position versus another position. I mean that I believe that we have a large group of stakeholders that don't closely follow or follow at all the work that we're doing on the conceptual framework. So there will be an invitation to comment. They'll see that it's attached to something that is an internal FASB tool. I hope I'm wrong, but I have a little bit of a concern about making sure that we don't overly rely on just the letters that we receive from this invitation to comment, and we do actively perform some outreach to make sure that we are advertising that this is out there, so that we are encouraging responses from groups that are not likely to necessarily be following the conceptual framework. I would want to make sure, again, I think assuming there is support to move forward, we have a very long period where this is open, so that it gives the time for people that haven't been following the conceptual framework to take the time to do that and give some very considered responses. I think that's an important part of the process.
Okay. So what I sense is the board as a whole is supportive of moving forward on an ITC, the Measurement Conceptual Framework. Why don't you guys work on a detailed outline, and then you can share it with the board and make sure that all of the perspectives of what we're looking for in there, and then, of course, share a draft with the board, and then we'll do a final draft with the board. Hal's point about, I guess the way I described Hal's point is almost a history lesson embedded in this document about how
It's certainly an element of that, yeah.
Yeah, about how, back when this was, back when the conceptual framework or the board started, this was the typical investment community. This is where it is today. This is what was considered back in the early 70s. And what do people think about that? Or somehow tie that history lesson in. to see if that changes the views of how the investment community is evolved over that time.
If nothing else, at least a quick summary with some references to, Steve Zeff's work and others that have done a really good job of summarizing that era.
Yeah.
Do that. I don't think you want us to go to the fact that I think the initial discussion memorandum on measurement in the 70s was 400 pages long.
Not the history lesson of what we've done, the history lesson of how the market has evolved.
No, I mean, that's the history of everybody, even before us, worrying about measurement was in that discussion paper.
Yeah.
It goes forever.
Mm-hmm.
Maybe that's a good read for all of us again.
Yeah, we definitely don't want 400 pages. We know that. 80, that's your goal. Okay. So Christine, on your concern on the objective, how does that, so you don't think we should move forward until we resolve that issue?
I feel that if we don't have a clear articulation of the objective, that the effort is fatally flawed, and that we will not get back information that will be useful to us. So given that as late as June of 2019, we were having discussions about whether stewardship and lost opportunities were things that should, that financial reports should provide information about that or not. I personally, you know how I feel about it, but obviously I'm in the minority, so we'll go ahead and
But you would be
see what we
okay
get.
if we articulated in the document what is our views of the current objective?
Well, I'm not sure where we're going to get that from, because the statement in the chapter of the objective is different than what's in the basis. So my question to the staff, I guess, is which one are they going to pick? Because I guess we're leaving it up to them to decide. So are we going to couch it as stewardship as a separate standalone objective, or that there's one resource allocation objective that's the piece I'm trying to understand.
Be guilty of our memo writing, misleading Christine.
Okay.
I think that I wasn't in any of the conversations, only Mike and Nick were. They tried their best to capture the views of people individually. There was no debate. I mean, it was just listening to them. And I read this thing completely differently, in that different people had points of emphasis. I think that the present objective indicates that. Different people have points of emphasis.
Okay, so
and I think that's all we captured, or Nick tried to capture when he wrote that memo. So we may have misled.
Would you agree with that statement that people have different points of emphasis?
Yes, I would agree with that
Do you
statement.
believe that different points of emphasis may result in different measurement conclusions at the standards level?
Absolutely.
Okay. I think that's a good point to bring out in this, because it helps people understand why this is so difficult and why the input is so important.
Okay, but let me just say then, I think it's going to be very important in this document that we say, if you start with an assumption that the objective of financial reporting is to support resource allocation decisions and stop and how, what flows from that, then here's what we would suggest about measurement. If you have the interpretation that stewardship is also a standalone objective, and that providing information about lost opportunities is part of the role of financial reporting, here's the implications of that.
Clear it's not a standalone objective.
Well, but that's not the way that the staff analyzed it the last time.
Okay,
Again,
but
we made a mistake in the memo writing where we said aspects of the objective. We probably shouldn't have titled it that.
But I think the broader point of that there are different points of emphasis, and depending on how much you weight that will often drive how you arrive at a standards level decision on measurement. And that is why we end up sometimes, the reason we end up in the mixed attribute model is because of that, and because of the lack of technology that was available when we probably created that. All that goes together to engage in a discussion about how to move this forward.
Okay, and then, and it will help me a lot, and I think it will help our audience for this document a lot if we can very clearly articulate how what we're proposing, all of these different alternatives, flow logically from that stated objective. I don't know how we can have one objective and have all different measurement principles flow logically from it, but I look forward to seeing that discussion.
I know Jim was going to me, I think it's also to Marcia's point, which I think is a critical point, is we need to think about how to explain to our stakeholders that are actually applying the standards how this document will impact the standards 10 years from now, to encourage them to participate in this exercise. I think that was your substance of your point, which is a great point, and that's something that we need to think about, and it may be additional materials outside of this document that can help tie it in, why they should participate today on something that probably won't impact their accounting for some time. But Jim's been patient, so.
And my only point was that in the small group meetings, and Nick, I appreciate your point that there was maybe some imprecision in the wording in the memo. I wasn't ever talking about a debate about whether something should be a reconsideration of the objective of financial reporting. I think I might have been one of the people that talked about opportunity costs and urged some caution about how far we might go with that. We could talk about things like, I invested in a plant in Des Moines, Iowa. My lost opportunity is that I didn't invest in one in Tampa, Florida. And I don't think we need to, I don't think that's where we ought to be focused. It wasn't to reconsider the objective. It was a point of maybe emphasis in the memo I thought was too strong. And so I don't know that there was some broad disagreement amongst the board on what the objective is.
Nice. Global warming, Iowa may have been a good place to go instead of Tampa.
Go ahead.
I mean, from my perspective, just coming at it from the investor perspective, the mission statement of the FASB is clear to me, right? Provide decision-useful information to users of financial statements to make resource allocations, equity, debt, creditors. And I think this thing about stewardship, the market votes on stewardship every morning. Market opened up, it's 9:37. The market is voting on the stewardship of a company's management and resource allocations. I think this debate about, in 1973, we had less technology. 1973, 2019, companies' values are based on discounted cash flows or some multiple of earnings. You can have more technology, less technology. That's how the world works. And I think going down other paths just complicates everything and doesn't accomplish anything. So I think we're fine where we are.
Okay, so we'll look forward to maybe a detailed outline, and then just I think that might be more efficient from a drafting standpoint, and make sure we're all on board with that. Anything else on the ITC? Okay, so now let's turn our attention to something we'll vote on elements. Jill?
Actually, I'm going to have Rebecca and Kelly teed up for you today.
Great.
So today's meeting is the decision-making meeting. The purpose of this meeting is to discuss two issues related to elements. The first issue relates to the definition of the term equity and the explanation of the term owner. And the second issue relates to whether the future concept statement should be consistent with GAAP for not-for-profit entities. Each of the two issues will be teed up separately. The first issue addresses the terms equity, comprehensive income, and investments by and distributions to owners. There are two questions for the board within issue 1, and each of the questions will be teed up separately. The first term to discuss is equity. Paragraph 49 of FASB Concept Statement 6 defines equity as the residual interest in the assets of an entity that remains after deducting its liabilities. Describing equity as assets minus liabilities and thus identifying it as a residual historically has not been considered problematic. In addition, the staff notes that defining the term equity as anything other than a residual makes it virtually certain that some financial instruments would not meet the liability or the equity definition. As a result, the staff recommends that the board maintain the definition of equity as it appears in FASB Concept Statement 6. With that, I turn it over to the board to discuss question 1 from the board meeting handout, which asks whether the definition of equity should remain as the residual interest in the assets of an entity that remains after deducting its liabilities.
Anybody want to change the equation? It's a good thing the college kids are gone, and we would have really messed them up. Go ahead.
So
I know new math is more complicated, but let's keep it simple.
So I do not want to change the basic accounting equation, but I do not view the basic accounting equation as a conceptual definition for equity. Okay? So I wish we could have had a kind of a more of an in-depth discussion about this issue. I don't find assets minus liabilities to be very useful in making decisions about equity as a board member. So.
What would be your definition?
So equity has two components. One is a plug to balance the balance sheet, right? Foreign currency adjustments that go into OCI would be one example of that. It's just a pure plug. And then there's also the component of equity, which is actual economic equity, like common stock. I would have at least liked to have had a conversation about whether we could do better with our definition of equity than assets minus liabilities. I don't know what that definition would look like. We haven't had that conversation.
We did earlier conclude that the amount, the discussion on foreign currency would actually is not conceptually correct, right? Because we said we're not going to take anything to comprehensive income conceptually. So that your point about it would not other comprehensive income.
No, we're talking about equity, right?
Yeah, but it would if we had
So
done it
it's-
right, it would have gone to retained earnings. It wouldn't have gone.
But it'd be an equity. Assets
Equity
minus
includes retained
liabilities.
earnings, right?
Right, yeah, that's what I'm saying.
Right.
I
And
understand
it would
that.
be there whether it went through net income or comprehensive income.
Yeah,
So-
I'm just saying that that definition of assets minus liabilities doesn't provide me as a board member really any way of thinking about equity when I'm making decisions as a board member.
Go ahead.
Just Christine, so I can understand this. If I change the word equity to residual, would that have solved the problem? Because that's effectively what it is.
There are different ways we could define what belongs in equity, right? One would be owners versus non-owners. Another one would be residual claims versus non-residual claims. Another way would be where there's a present obligation, where there's not a present obligation. All of those characteristics could be incorporated into a definition of equity that is a bit more useful than just assets minus liabilities. That's all I'm saying. But we're not,
Okay.
I get that we're not having that conversation, but that's the conversation I would have liked to have had.
Okay. I don't see any real need for that at this point in time, but I'm quite comfortable with where we are, so.
No, I know.
Yep. I'm perfectly comfortable with it. I actually think if we went the other way, we're going to end up with, unless it's the exact opposite of liabilities, we're going to have two separate definitions, and then we're going to have to resolve the Venn diagram of the overlap, or just admit that equity is everything that's not a claim, that's not a liability. I don't, unless there's overlapping things that are both liabilities and equity, can't see how it could be anything other than that.
Before I call a vote on
mathematic.
no.
When I don't remember now when, had the compromise with respect to is everything that's a present obligation a liability, and the board said no, not present obligations too, and the two was to provide instruments, either with an option or a forward, that did not present any present obligation to the entity except in liquidation, which is the next, somewhere along here, we're going to say, which we'd like to describe as owners, because they're not people that have are the counterparty to a present obligation to deliver anything other than things that will not have any rights other than in liquidation. That was the foundation of that agreement, and that's what we were just trying to build on.
So, with respect to question one, who believes that the definition of equity should remain as a residual interest in the assets entity that remains after deducting liabilities? That's 6. Okay. We'll go on to question 2, Rebecca.
So the second term to discuss is owner. While owner is not an element, the explanation of the term affects the definitions of comprehensive income, investments by owners, and distributions to owners. The fundamental criticism of the existing definition of the term comprehensive income is that it uses the term owner. Currently, there's no definition of the term owner other than to describe it as a claimant of the residual assets of an entity. The staff believes this criticism can be addressed by adding a discussion of the term owner consistent with the board's decision on distinguishing between liabilities and equity. Similar to the definition of the term comprehensive income, a clarification of what is meant by the term owner is necessary for the definition of investments by and distributions to owners. Individuals can function as both owners and non-owners, so it's important to clarify that transfers between a business enterprise and its owners refers only to owners acting in their capacity as owners. In order to make such a clarification, the term owner must be consistently explained. The staff recommends that the term owner be explained as the holder of an instrument that creates no present obligation of the entity other than in liquidation. With that, I'll turn it over to the board to discuss question 2 from the board meeting handout, which asks whether the term owner should be explained as the holder of an instrument that creates no present obligation of the entity other than in liquidation.
Jim?
So I'm not sure how much confusion it creates or not in practice today. I've heard a lot, but so I'm not sure we need to change how it's described. If we do, I have maybe 2 concerns, one perhaps bigger than the other. It talks about an owner is the holder of an instrument. I'm not sure all owners hold instruments. I'm not sure that works for partnerships, cooperatives, or other things that might not be instruments. I'm not sure a partnership interest is an instrument. And so this might create more confusion in thinking somehow we don't think partnerships are within the description. We're going to have to define instrument because a partnership interest is just an interest. It's a claim, and what we used to describe it as is a claimant. And so we could, instead of saying holder of an instrument, we could say a claimant with no rights other than in liquidation, or we could say a claimant whose interest is not classified as equity, or as a liability. That helps with sort of the circularity. That's a smaller point because I think we have the corollary in that piece. Gotcha. No, I got you, but I think if we're trying to do proprietorships, then the instrument is also needs to sort of be. Okay.
I guess I had always taken the word instrument contracts, and which would include partnership agreements and things like that. But if there's confusion, we can clear.
Christine?
So I just want to make sure I understood how all the pieces fit together. So if an entity has an obligation to issue a fixed number of shares, that would be classified as equity? No, I know, I dissented from that, but anyway. Okay, so that would be equity. And so if we had a holder of restricted stock units, that would be classified as equity, correct? Okay. But they would not be considered an owner, or they would be considered an owner under this definition? Creates no present obligation of the entity other than in liquidation. So there is an obligation for restricted stock units for them to issue stock. So that's not what you guys consider.
That's what you voted the last time, 6-1.
Well, we didn't vote on what an owner was, so that's how I'm asking about how this definition is going to be applied.
The holder of those instruments that you said were equity, we're going to call owners.
Owners, okay, so stock options are owners. Everybody is an owner if they're in equity.
Yes.
Okay, thank you.
That's why I liked the not classified as a liability, because then you can avoid saying the part about doesn't have a present obligation.
Yes. So there is a third question on this paper that somehow didn't make it into the handout, and that's about comprehensive income, the definition of comprehensive income. Paragraph 5 of the board paper quotes concept statement 6 with the definition of comprehensive income. The staff, it's the board, it's not the handout, it's the memo. The staff's view is that the intent of the term comprehensive income should continue to be a function of the accounting equation represented by the difference in recorded assets and liabilities. Therefore, we are recommending that we retain the definition of comprehensive income as in Concept Statement 6. So question 3 in the board paper is, does the board agree with the staff's recommendation on that?
Okay, so any discussion on that?
All right, I
I'll
thought we had a vote on
I'll
2.
vote on 2, but that's okay. Okay, so with respect to question 2, in the board handout, well, let me think about this. Do you want to revise the question, or are you okay with if I just call the question?
You can call the question. I think if you could view that as part of drafting it.
Is that okay? All right, so who agrees with the staff's recommendation with the drafting improvements by Jim? That's all 7, okay. Is that all right? Okay, and then with respect to the additional question that's not in the board handout, but it does reference what's in paragraph 5 and 6 of the board handout. Staff's recommending that we do not change paragraph 70 of concept statement 6.
Correct.
Who agrees with that?
Sorry, which,
But,
Comprehensive income.
Definition of comprehensive.
Did you want to talk about that?
no, I don't want to talk about it, but I'm not going to vote to support.
Okay, all right. Do you want to just say why? Or,
No.
no? All right, okay. Okay, now we'll move on to the Kelly on question 3 in the board handout.
The second issue addresses not-for-profit net asset classifications. Accounting Standards Update 2016-14 amended net asset classification requirements and established 2 classes of net assets: net assets with donor restrictions and net assets without donor restrictions. The change in the net asset classification requirements was made to reduce complexity by eliminating the distinction between resources with permanent restrictions and those with temporary restrictions. Some of the concepts described in Concept Statement 6 related to not-for-profit entities are inconsistent with the board's recent standard-setting activities and continue to address 3 classes of net assets rather than the 2 described in ASU 2016-14. Specifically, paragraphs 91 through 94 of Concept Statement 6 state that there are 3 mutually exclusive classes: permanently restricted net assets, temporarily restricted net assets, and unrestricted net assets. The staff recommends that the board amend the future concept statement to be consistent with the amendments in ASU 2016-14. With that, I'll turn it over to the board to discuss question 3 in the board meeting handout, which asks whether the board wants to amend the future concept statement to be consistent with the amendments in 2016-14.
Any concerns with that? So for formality, question 3, who agrees with the staff's recommendation? All right. You good? You got a question? No? Okay. All right, great. Can we take a break and come back at 5 after 10? Okay, welcome back to our board meeting. Now we're going to turn our attention to our project on reference rate reform, facilitation of the effects of the interbank offered rate transition on financial reporting. So I'll turn over to the staff, specifically David.
Yep, thanks, Russ. So today we're going over the feedback we received on our reference rate reform proposal, and we're asking the board to either affirm what was in the proposal or to make certain changes in responses to that feedback. At the end, we'll ask the board for permission to proceed for drafting towards a final update. The feedback is summarized in the meeting handout and in the board's materials, so we'll refer people to those documents rather than repeat what's in there. I'll just highlight that overall the feedback was quite positive and we received broad support for the proposal. So the changes the staff is asking the board to make this morning are more about fine-tuning the proposal rather than fundamental changes. I'll turn it over to Demi to tee up question 1 for the board.
As noted in the feedback summary, a few respondents asked the board to allow the sale or transfer of securities classified as held to maturity if those securities reference a rate that is discontinued or expected to be discontinued. The staff agrees with the concerns raised that are summarized in the board handout, and in response to that feedback, we are recommending that the board provide additional optional relief to allow a one-time entity-wide election to transfer securities affected by reference rate reform and were classified as held to maturity before January 1st, 2020. This expedient would be optional, and entities could make this one-time transfer at any point before the termination date of Topic 848, which is when the relief would expire. The accounting for recognition and measurement would follow the existing guidance in subtopic 320-10 for transfers out of held to maturity. The first question for the board is, does the board want to provide additional optional relief to allow the transfer of held to maturity securities that are affected by reference rate reform? I will now turn it over to the board to discuss question 1.
The staff has a recommendation. Are there other alternatives the board members would like to discuss about this topic? No? Okay, I think, my personal views, I think this is a good thing. I welcome the feedback we got, and I would like to move forward on your recommendation of a one-time, an eligibility to have a one-time transfer for those that are classified before January 1st, 2020, and they must do it before what, in essence, will be the sunset provision, assuming we're going to vote for a sunset provision. Jim?
We talked about it in the SGM. I just want to be clear that the one-time means the entity has one time. It doesn't have to be in the period that they initially adopt this relief. Is that right? So you could say, hey, I haven't figured out how I want to reposition because of. So my one time could be Q3, or my one time could be, 2021 Q1. But they only get one bite at the apple. That's the point.
Yes. Any time within the window, but you can only do it once.
Yeah. Okay.
Hal?
That would not be my first choice. I think.
That's why I asked for alternatives.
No.
Intelligence told me there was another view.
My option here would be to do it on a security by security or portfolio basis. I would think we ought to, this is a unique set of facts and circumstances. It's going to be short-lived, relatively short-lived. That's why the sunset provision was so important here. But I don't want to put any hurdle in place that could prevent them from making this as smooth a transition as possible. I'm not terribly concerned about abuses here. I think they're going to do the things that make economic sense for them. And I'm a little concerned that you've got to pick the one time during this time period. I think that's I think we'll have to revisit that issue if we go down that path. So I'd much rather greater flexibility here.
But your limit on the flexibility would still be based on those that were classified before January?
Yes, I think that's a good, and we can debate what that cutoff date is, but I think that.
So the only difference would be, rather than having to do them all at once, you would allow within the window of opportunity the piecemeal.
I just get the sense from everything I've heard that I think that one-time decision is going to put a lot of stress on the system, a lot of stress on each individual bank. A lot of resources will be spent. When do we got one shot, when do we do it? And I think that we're going to find that to not be very operable.
So the staff, after considering how your recommendation is still there, what input did you get about your recommendation?
Yeah, so the recommendation was based on, that was the request that was submitted to us by the respondents. So the respondents that raised the issue had asked for a one-time transfer. I think we can certainly acknowledge and understand Hal's point of view as another alternative, but given that was the request that came in, that's why we had that recommendation.
Jim?
I understand how that sort of the need for flexibility. I guess what this also would do, because it's not just sale or it's not just sale, it's sale or transfer. So you could still do it one time, and if you were uncertain, that you would transfer it, not sell it. I mean, if you had significant uncertainty, you just say, look, I'll admit this is what it is. It's in my AFS portfolio. If you were concerned, I don't know whether I'm going to hold or sell.
Right.
If you already were to the point you were going to sell some,
Yes.
then you would just maybe put more in.
That's
AFS.
right. Once you transfer it to AFS, there's no subsequent tracking as to I have to sell those within a certain time period. You can choose
I can hold or sell.
Exactly. You can continue to hold those in AFS. You could sell those, but that's right. You have to transfer it first before you can sell to prevent the tainting.
And that was part of my concern. I have no idea how this will play out, but if you take all this HTM and you put it available for sale, all of a sudden, does that put provide more opportunity to do more trading in the market? Does that disrupt the market because you have a flood of securities? I don't know. I could play it the other way and say that added liquidity in the market could be very positive. I think that we're putting a lot of stress on the system at a point in time where we shouldn't be doing that.
Christine?
Is there any uncertainty, do you think, in the minds of entities as to which securities are qualifying? And what I mean by that is, do they know for sure which of all of the different reference rates are going to discontinue? Or is there any could there be ones where they think, well, we're not sure if this is going to discontinue or not?
Yeah.
So they wouldn't be able to necessarily at one time identify all of their qualifying securities.
Yeah, I think that's a fair point in that obviously this goes beyond LIBOR. There's other reference rates around the world being reviewed, and there are different stages of regulatory review. So there's uncertainty for some of these other rates as to whether they will be discontinued, and if so, what the timing is. I think the other aspect is even for LIBOR, as people are working through the different product types, in terms of trying to work out how to deal with modifications of fallback languages. There might be certain products where there's more certainty as to how those are going to be modified, and other products where there's more uncertainty as to how operationally or legally challenging it might be to modify those contracts. And where an entity is at in that review, I think varies. We've heard from entity to entity as to how far along they are in that process of inventorying their products.
And there are existing disclosure requirements in U.S. GAAP when there is a transfer from HTM to AFS. Correct?
That's right.
And those disclosure requirements would be applicable if a company chose to take this relief.
That's correct, which includes describing the reason for the transfer from HTM.
Okay. So let me call two perspectives. I don't see any concerns about the cutoff period or the optionality. The cutoff period being those classified prior to January 1st, 2020, and that this be optional. But I do sense that we may have differences of opinion regarding the staff's recommendation, which is this is a one-time election for all of those eligible versus a piecemeal. And if the majority of the board want to do piecemeal, we can talk, is it security, is it a portfolio, what is the cut? So with respect to, I'll call view A as the staff's recommendation, view B is the piecemeal house perspective. Who supports alternative A? So that's 5, and alternative B would be a piecemeal approach to 2. Okay, all right. So why don't we go on to question 2? Is that still you, Demi? No? Okay.
Questions 2 and 3 relate to contract modifications, and those questions will be teed up together. As noted in the feedback summary, there was broad support for the proposed expedients for contract modifications and the election level for contracts. But we did receive some concerns regarding the scoping criteria used to identify what contracts are eligible for relief. Some of the feedback recommended emphasizing the principles and making clarifications to the examples of what changes are related and unrelated to reference rate reform. The staff recommends that the board affirm its previous decision to provide relief for contract modifications if the changes that are made are related to reference rate reform. And in drafting, we will clarify the examples of terms that are related and unrelated to reference rate reform to improve the operability and auditability of the guidance in response to the feedback we received. The questions for the board are as follows. Question 2. Does the board want to affirm its decisions regarding what contracts should qualify for relief and what changes should be permitted, and clarify the examples of terms related and unrelated to reference rate reform to improve the operability and auditability of the guidance? Question 3. Does the board want to affirm its decisions on the explicit relief for certain topics and provide a principle for other topics not explicitly specified, and that the option to apply relief is on a topic-by-topic basis? I will now turn it over to the board to discuss questions 2 and 3.
Thanks, Alexia. Are there any questions about the staff's research and how they've taken the comments and the outreach and tied it into their recommendation and changes? Does anyone think we should have gone further based on our reading of the comments? Everyone wants me to call a vote? Okay, all right. Okay, so everyone's getting excited about later. Okay, with respect to what's articulated in the board handout, specifically question 2 and 2A, Alexia has articulated the staff's recommendations subject to final drafting. Who agrees with that approach? That's all 7. Okay, with respect to question 3, specifically 3A and B, who agrees with the staff's recommendation as articulated? Okay, that's all 7. Okay. Thanks, Alexia. Who's doing hedge accounting? All right, Julie's doing hedge accounting. That makes sense. Julie's doing hedge accounting. I should have known.
Thanks, Lars. Question 4 and 5 are related to hedge accounting, and those questions will be teed up together. The proposed update covers 3 main areas of optional expedients for hedge accounting, which are changes in critical terms, fair value hedges, and cash flow hedges. As noted in the feedback summary, there was broad support for the proposed hedging relief, but there were a few things that stakeholders asked us to change. I want to highlight those changes that we are recommending to the board. For question 4, the staff is recommending the board provide optional relief to allow entities to amend method for amortizing excluded components to prevent any amount being stranded in other comprehensive income. For example, the basis spread in cross-currency swaps accounted for as excluded components. For question 5, specifically for fair value hedging relief, the staff is also recommending the suggestion from few comment letter respondents to require the change in fair value hedging basis adjustment to be recognized in earnings immediately, consistent with current GAAP recognition for basis adjustment. Other than this limited change, the staff recommends affirming the remainder of proposed hedging relief.
Yeah, and just before I turn it over to the board to clarify question 5, in the exposure draft, we talked about flexibility or different ways to calculate the change for the fair value hedge basis adjustment if you're moving from one benchmark rate to another benchmark rate, and some of those methods would result in no change in the basis adjustment, and other methods might result in a change in the basis adjustment. So this would be for those entities that are applying a calculation method that results in a change in the basis adjustment. That piece would be recognized in current earnings, and removing that optional piece we had in the exposure draft to hang that amount up on the balance sheet and recognize that over time.
Okay. Anything else, Julie? No. Okay. Any questions or observations on what is question 4 in the optional relief to change your accounting policy application? And this would just be, you can just change, you don't have to assess preferability, just one-time change if you want to do it. And that one-time change would occur throughout?
Hedge by hedge, yeah.
Hedge by hedge, okay.
And that would be, again, triggered by you've had something change in the derivative that's designated in the hedging relationship. That's now likely caused the excluded component amount to potentially have changed. So this would allow an entity to update or amend their systematic and rational method for how they're recognizing that out of other comprehensive income and into earnings.
But is this a situation where you may have this scenario at the beginning and then also in the middle of the period? In other words, we've got a period of a window, if you will. Would you have to make this determination to change at the beginning, or could you do it at any time? In other words, could you have some that this was applicable to and you didn't change it, and then say in 22 you changed it?
Yeah, I would think of it, it's more like a trigger-based kind of change. So something's happened to the derivative. So if you're using the cross-currency swap example, if you had a US LIBOR to GBP LIBOR, now because of rate reform, that's changed to US SOFR to GBP SONIA. As a result of that, that cross-currency basis spread amount might change. And so, again, it's like that point in time when the derivative terms change is when you would be applying this relief.
Okay. Jim?
So, as you were talking about that, and then as you described it again, and it's to update it, I guess, to make sure you don't have stranded amounts in OCI. Is the inference, since it's elective, that I could leave amounts stranded in OCI?
I think I don't think anyone would want amounts stranded in OCI, so I think the alternative, if we didn't have this option, is you'd have what we call a cliff effect, meaning I was following, I was kind of locked into how I was systematically and rationally doing it before, but that didn't get sufficient amounts out of OCI. So in my last period, I know I shouldn't have anything left in OCI, so I'm having to do a big catch up in that last.
I just want to be clear that if you didn't elect this, that amounts associated with that contract are going to hit income. It's just lumpy.
Mm-hmm.
Okay.
Anything else on question 4? Okay. The staff is recommending we provide additional optional relief for excluding components and hedge accounting relationships that are affected by reference rate reform. Who agrees with that? That's all 7. Okay. Okay, so with respect to question 5 and 5A, 5 is we're in essence saying the staff's recommending we affirm all of our prior decisions except for requiring changes in fair value hedge basis adjustments to be immediately recognized in earnings. In essence, who agrees with both components of 5 and 5A? Yeah, go ahead.
So I preferred this approach back when we discussed it before, and I continue to, so I'll vote for it. But I just wanted to bring up that I do also feel, and voted this way the last time, that there should be a disclosure requirement associated with this. I think this is an amount that entities will have to calculate. They're going to know what the number is. If it's material, I think that users need to know that amount because it is non-economic, it's non-cash, it's one time. And, I believe that among our objectives when it comes to disclosures in this area is to help users to understand how hedge accounting is impacting the financial statement. So I know that the staff felt that if it was material, entities would potentially on a voluntary basis call this number out. My concern is that they will do that in a non-neutral manner, that they'll non-GAAP it when it's income decreasing, and they may or may not call it out when it is income increasing, and it will be buried. So we already have existing disclosures that require those gains and losses on fair value hedges to be disclosed in the notes. I would just like to see that disclosure expanded for the period of the transition to call out this piece that's an adjustment solely related to the transition accounting that we're affording.
Anyone else have any thoughts on that?
I think Christine stated it perfectly. This is a number that a company has calculated, has to recognize, measure, and present in the income statement or the balance sheet equivalent. Therefore, why can't they simply disclose it?
Jim?
Do companies have to calculate the number? Is this, to disclose it, wouldn't it have to be on a with and without basis? They already have to disclose the aggregate basis adjustment, right? That's part of the table. So in order to get this number, you'd have to know the basis adjustment and then the hypothetical basis adjustment to isolate this basis adjustment. It might.
Potentially, I think it might depend how they're calculating it. If they're just doing, what was my basis adjustment at the beginning of the period, and now I'm calculating all my basis adjustments at the end of the period, I might not be isolating this particular amount, but if we wanted to call out, well, what of that amount related to the basis adjustment, I think potentially you would be requiring then to kind of do maybe a with and without.
I think that would be the only amount that would be associated with the change, because there would be a different basis adjustment at the end of the year had you not changed.
Correct.
And so if what we're, and that aggregate basis adjustment is required to be disclosed. So I think the disclosure being asked for is not something companies calculate or would calculate. It would have to be, what would be my hypothetical basis adjustment, and then what is the SOFR basis adjustment, and then the difference between the two would be the incremental disclosure that's not required today. So I don't think it's something companies know.
Go ahead, Ed. Is that what I don't think that's what you're asking for, is it?
Yeah, it is. So my understanding is that they have been doing their fair value basis adjustment under LIBOR. Now they're going to switch it to SOFR because they switched their hedging, their derivative to SOFR. And so my concern is that there is going to be this adjustment, and if it's material, it's a one-time thing. It has no cash consequences. It has no economic content. And if it takes a little extra effort on the part of companies to do that adjustment, to separate the LIBOR piece from the SOFR piece, I think that is an important disclosure for users. So
help me understand.
I would still argue that we should provide it.
Help me understand the difference between the amount that we would be required to be recognized immediately in earnings and the amount that Christine and Gary are talking about being disclosed.
Yeah, so I think it comes back to we're providing flexibility in how the calculations are done. So there's multiple methods people could use. And so depending on which method they use, there might be this change in like an immediate change in the basis adjustment, like a point in time. So I think that's...
But would you be comfortable with a disclosure that said the amount that you were required to recognize immediately in earnings under 5A is what's disclosed? Okay, so
that's what I'm asking.
So why is that a different calculation for the disclosure than it is for recognition?
Well, that's why I was, if it's not, then if we're saying just disclose what was immediately recognized in earnings, and you're saying that that is a discrete calculation, then I guess fine.
Yeah, so maybe a simple example. So the way you're calculating the basis adjustment, it's basically taking my future cash flows and discounting it at my designated benchmark rate. So if I just report it at the end of the period, I would say, let's say 6/30 is my end of the period, I'm doing the calculation. What's my future cash flows at that point in time, discounted based on the discount rate as of 6/30. But if the derivative had actually switched, say, on May 15th, that if I was to isolate this piece, I would be saying, all right, I'll do the calculation on May 15th because that's when my derivative changed from LIBOR to SOFR. So do the calculation again at that trigger date, and to say, all right, on May 14th, when it was based on LIBOR, here's what my basis adjustment was. Now on May 15th, the derivative is based on SOFR. Do the calculation. That's the change, as opposed to just doing the calculation at the end of the reporting period to update what the new cash flows and discount rate is.
So what is in 5A, based on your recommendation, is a balance sheet to balance sheet.
Right.
Right. Is that what you're asking for, or are you asking for the May 14th, May 15th example?
I'm asking for the change in the fair value hedge-based adjustment that's immediately being recognized in earnings to be called out, because that piece...
So that would be the balance sheet to balance sheet. So some of that wouldn't be LIBOR to SOFR, it'd be other things.
I mean, I think hearing Christine describe what she's looking for, you're looking for isolate
Yeah, I would prefer
isolate the
something that
LIBOR to
was,
SOFR piece.
yeah, I would prefer something that was a better measure of the change that is related to the fact that we're just doing an internal accounting adjustment to go from LIBOR to SOFR, and that's causing the fair value of this thing to change. That's the piece that users would want to know.
Right.
That's what I'm asking
That's the
for.
14th to the 15th in his example.
Right.
But the amount that we're requiring to go immediately to earnings is not the 14th to the 15th.
Well, it always all goes into earnings. I mean, that's, yeah.
Lumped with other stuff.
That's what I
Yeah,
mean. It's
no,
not
I mean,
just that.
Well, I mean, it always goes to earnings. The fair value adjustment in total goes to earning.
What we need to decide, this is what I think the tension point is. I personally don't have any concern about making someone disclose something they've already done. So we can either say no disclosures, it's just in the income statement and market can decide if they want to see it. Or we can say require disclosure of the amount that's immediately recognized in earnings. Or we can say require the actual amount that's been reflected in earnings, that is the explicit value transfer or from LIBOR to SOFR. And that is
it's not a value transfer, but change in fair value.
But that is a separate calculation than what we're requiring in earnings.
Depending on how they do it, yeah.
Yeah.
I mean, not necessarily, but depending on how.
And that would also be something we did not expose in the exposure
No,
as a
we didn't
requirement.
expose the held to maturity decision either. We didn't expose that. So, I mean,
But the modification, though, that we made on the held to maturity, that change is a change adding flexibility, not a change adding a requirement.
Right, but we did actually have this disclosure discussed in the basis for conclusions. We included a question in it, and we also did outreach with users to try to understand if users would find this information useful. It would be an equity analyst that would find it useful. I don't know how many equity analysts that we talked to. Okay.
Right,
One
but
said
the
that-
staff went through that process and did not recommend the disclosure.
I understand the staff didn't recommend the disclosure. I disagree with the staff.
Okay.
Okay, so with respect to the actual accounting, the staff is recommending we affirm all of our prior decisions, but require the change in fair value hedge basis adjustments to be immediately recognized in earnings. I'll call the accounting, and then I'll call various alternatives for the disclosure. So with respect to the accounting, who agrees with the staff's recommendation? 558. Okay. With respect to the potential for additional disclosures based on the amount that is required to be immediately recognized in 5A, I think there are three perspectives. The first perspective is to affirm what we had in the exposure draft, which is no disclosure. The second would be to require disclosure, subject to materiality, I suppose, of the amount that was recognized in earnings. And then view C would be to require disclosure of the basis adjustments of going from LIBOR to SOFR. Yeah.
I just want to ask the staff, is B, as described, any different than what is currently required?
Sorry, which,
Well, so Russ said that B would be disclose the amount recognized in earnings, but that's already required.
so I think the only difference would be, you might have other fair value hedges that are not LIBOR-based. There's other benchmarks that might not be affected by rate reform, so that could be the distinction.
Okay, so you would have to separate out then the, currently the disclosure is this is the amount that was recognized in earnings. It would need to be separated between those where you did a basis adjustment versus those that you didn't do a basis adjustment.
Yeah, or yes. So, I had, here's my total fair value hedge basis adjustments for the period, which is required today. One subset of that would be of that number. Here's what were previously LIBOR before the beginning of this period. Now there's transition to SOFR, another benchmark rate. So I'm showing just that total impact to the current period. And then I think C is then further isolating even further to say what was the actual point in time change as a result of that.
Okay.
I think the benefits, I mean, C is probably more beneficial to users than A. That's the obvious. More information is more beneficial. The cost, A is probably the cheapest, B and C is probably the most expensive because you have to do a separate calculation. And B is more expensive than the existing requirement because you're going to have some form of isolation. But in theory, your books and records would already have that because you need it to book your journal entry. Right, that's kind of how the cost and benefits work out. So, any questions in the three views? All right. Who would support alternative A? Alternative B? And you guys alternative C? Okay.
B and C are close, right? I mean, how far off is B and C?
It's a big difference because you have to have a whole nother calculation.
But I'm
to
saying
see.
from an economic perspective, is B and C that different?
Yeah, it could be.
Talk economics versus accounting internal controls. Is B and C that different from an economic perspective?
So the overall change could be going in a completely different direction than the change that is just due to the switch from LIBOR to SOFR. Okay, so they could be completely unrelated to one another. There's no information content.
Then I would be in the C camp.
Yeah. And Russ,
I can't live with C because I don't want to force someone to have a separate calculation.
Right, and to that point, I've got to envision this is a big project internally, particularly for those who are most exposed to this.
Right.
I have to think that this is a number that people are going to be focused on internally. What did this ultimately cost us? And that's going to affect a lot of decisions that are going to be being made internally. So while you couch it as a new calculation that no one's ever done before, I would think that this would be a significant number that you'd be reporting up to management.
Perhaps, but it's not the number we're requiring on the income statement, and I don't want to force someone to a separate calculation for the footnotes.
I appreciate that. And my personal view is that we're giving tremendous latitude here to do a lot, providing a tremendous amount of flexibility during a short time period. With that flexibility requires some level of quantitative disclosure. No disclosure is totally unacceptable. Is this the first item that I would choose for disclosure? No, but I think it's a critical element in understanding what's going on. I think it's critical not only externally but internally. So I believe that this is a number that will be known, or at least something in this category would be known.
Arjun?
Well, so I'm trying to think through, we're requiring something to affect earnings immediately in the public company environment where there are regulator requirements that require descriptions of, material changes, if it has affected someone's trends, if it is distorting something, then I think there would already be, absent anything we require as part of this waiver or amendment, there'd already be a requirement to talk about, explain why your trend is affected by this if it modifies the trend. So I can understand curiosity about this, but it feels to me that the system today would already capture if it's a material driver in the period that is recorded.
Christine?
So to Hal's point, I think entities are going to need to track this, because if it's material, they're going to need to be able to explain it to their investors at the end of the period. And when I asked entities about non-gapping this number, they said yes, that they would, because it's non-cash, it's non-economic, and it's one time. So they're going to want to know what this number is so that they can explain it to their investors after the fact if it's material. They're not going to be able to go back and recreate it. So I'm very skeptical of the argument that they are going to be oblivious as to how much of their earnings is being driven by a non-economic, non-cash, one-time charge.
Following up with Christine's point and Marcia's point, if you have to determine whether it's material, you have to measure it.
But you only have to
According
determine
to everything
that.
I've heard for the last X number of months of that year.
But you also have to prove
Do it.
in the audit, in the internal controls environment, that it is not material.
But how
so
would you
the
do that?
requirement that we would put on here,
How would you determine that?
we'd be forcing companies where this is not going to be a significant effect to their results to go through a calculation to prove that it's not a significant effect to the results. So that I'm with Russ that, to me, alternative C from a disclosure perspective, I can't be comfortable supporting that at all. But I also want to just, as I listened to Christine's comment, I thought, we've had this conversation before. When you look at the other aspects of what what an entity communicates. If they choose to non-GAAP something, if they think that's important for someone to understand their results, it's bringing transparency to it without adding a requirement and without adding the cost to other entities for whom this may not be a significant driver.
Okay, my concern, though, is that that choice is not neutral. We know it's not, right? They non-GAAP bad news. They don't non-GAAP good news.
I don't think that's a fair statement in all cases.
I'm not saying it's a fair statement in all cases. We're writing disclosure requirements that are mandatory for everybody.
So perhaps, let me, before we finalize our decision here, are there other disclosure? So the staff want to do transition and sunsets and then get to disclosures. Can we hold off on the disclosure conclusions? We talk about all of the disclosures? And I promise you we'll get back to this discussion and have this.
Yeah, I just wanted to do it here because I want to make sure that it was clear that it's related to this recognition and measurement decision we're making.
Yeah, I agree with that. Okay. So why don't we move on to 6, transition? Demi, she's, okay.
Questions 6, 7, and 8 relate to transition, and those questions will be teed up together. As noted in the feedback summary, there was general support for the proposed prospective transition method. I just want to highlight a couple of changes that the staff is recommending in response to the feedback we received. For question 6, a few respondents expressed concern about the transition provision requiring smaller or non-public entities to early adopt the new hedging targeted improvements guidance, which is update 2017-12. In response to this concern, the staff is recommending that if an entity has not adopted that new hedging guidance, they can still take advantage of certain relief for hedge accounting. Specifically, the relief allowing for changes in critical terms of a hedging instrument or a hedged item, the relief related to the probability of the hedged forecasted transaction, and the temporary relief allowing the application of the private company simplified method to assume perfect hedge effectiveness for new and existing cash flow hedges during the relief period. For question 7, a few respondents recommended that the guidance be applicable for the beginning of the period in which the guidance is issued. The staff agrees and recommends that application of the guidance can be applied prospectively from the beginning of the interim period that includes the issuance date of the final update. And lastly, for question 8, we are asking the board to affirm its decision that the guidance should end as of January 1st, 2023. I will now turn it over to the board to discuss questions 6, 7, and 8.
I stalled on disclosure, and this is going to be an easy discussion, so it wasn't. Any questions on 6 and 7? Okay. Who agrees with the staff's recommendation in question 6 regarding the hedge accounting? That's all 7. Okay. Who agrees with staff's recommendation in 7A and 7? Okay. So with respect to the sunset provision, you have something, Sue?
I just want to comment
Go ahead.
on the sunset provision. I think, I'm certainly acknowledging the staff's approach to the sunset provision and the decisions and objectives that the board has with respect to the sunset provision to help operability and cost and complexity, et cetera. I think overall my preference would have been to develop some kind of a principle. I believe that's not where we are right now. And so where I have gotten myself comfortable there is just sort of taking a step backwards and thinking about what was our overall objective when we were trying to develop this guidance. And it was really to ease the burden around the volume of transactions. And as I went back to some of our previous memorandums where in the early days of our dialogue we had an appendix that detailed out what all other countries were doing, because that's specifically what my concern was around the sunset provision. Most of the countries that are within the band, if you will, of the sunset provision, and I would say that the recommendation that the staff has captures most of those. And so then when I think about it in terms of the objective of the volume of transactions, I can get comfortable there. Generally speaking, I would have preferred, but I'm going to support the staff on the sunset provision.
Okay. Jim?
So I agree with Sue. I think it's a tough issue. I suspect if we're starting to use accounting terms, it's probable we'll be revisiting and having to extend the sunset provision, but we have it there, and it allows us to move forward. The one question that I had, and this came from the private company community, was the sunset talks about contract modifications made and hedging relationships entered into or evaluated after December 31, 2022. And private companies have a time period after 12/31 to do evaluations of their 12/31 hedge positions. And so I think it was our intent to allow those hedge evaluations to occur in 2023 as long as it related to 2022 reporting. But that was a particularly important point that at least one private company constituent raised.
Yeah, we can clarify that in the drafting.
Okay. Okay, so subject to clarification on when a private company would, how this applies to a private company related to their hedge documentation, who agrees to include a sunset provision, and that sunset provision should end on as of January 1st, 2023. That's all 7. Okay. So now why don't we tee up the disclosures that you are recommending, and then we can engage a discussion with the board about other disclosures, and we can decide if we want to do it and where we want to do it. Does that seem okay with everyone? All right. James, you look like you're getting ready, so
yep.
Go for it.
All right. Questions 9, 10, and 11 relate to disclosure, so I'll tee them all up together. As noted in the feedback summary, there was general support for the transition disclosures that were included in the proposal. And as a reminder, those would have required an entity to disclose the nature of the relief it elected and the reason for electing that relief. The proposal also included questions about whether additional disclosures should be provided. Some of those potential additional disclosures were related to application of the relief for hedge accounting, and some would have highlighted an entity's current holdings affected by reference rate reform. As a reminder, the board had discussed adding a separate project to its agenda for the latter. A common theme among the responses that were received to those questions was that SEC and other regulatory disclosure requirements would meet the objective of those additional disclosures, and that disclosure of the effects of hedge accounting expedients elected by a reporting entity would be of limited usefulness. So for question 9, the staff recommends that the board affirm its decision to require entities to disclose the nature of and reason for electing the accounting relief. For question 10, the staff does not recommend adding any of the relief application disclosures beyond the nature of the relief elected and the reason for electing it. And for question 11, the staff does not recommend adding a project to the board's agenda for the exposure disclosures. Staff evaluated the agenda criteria for such a project and did not believe that all of the agenda criteria would be met. And so I'll now turn over to the board for discussion on questions 9, 10, and 11.
So let's first focus our attention on 9 and 10, and then we can have a debate about 11. Any comments on 9? Yeah, go ahead.
So my concern with what's described in question number 9, the disclosure that we proposed, is that it is going to be very boilerplate, and that it is not going to convey very much useful information to help users understand the extent to which these various accounting relief options have been applied by a specific entity. I mean, I'm not sure what staff is envisioning, but when I sort of think about what I might expect to see companies say, is they may say, well, we took advantage of option A, B, and C, and we did it because of reference rate reform. So in order to try to provide a little more information to help users really understand the extent to which a particular entity applied the optional accounting relief, in looking at the disclosures that are currently required, there is volume-related disclosures that entities are required to provide. to help users understand the level of an entity's derivative activity. And they are permitted to provide that disclosure either based on nominal amounts or, we sort of let them decide. So I would like us to require that as part of those disclosures that they're already doing, that they say, well, for this volume of activity, we took advantage of optional relief. And for this volume of activity that we're disclosing, we didn't. So basically put it into two buckets. That would allow a user to say, well, a lot of their activity was affected, so now I may want to ask the manager a lot more questions about the numbers that are appearing in the financial statements as to whether or not they're indicative of what the numbers would have looked like if they hadn't taken advantage of the optional relief. Or if it's a very small proportion, they can say this is not something that I'm worried about. So again, my concern is that we have made decisions, I think for good reason, to provide optional relief to entities. I feel we are currently not doing enough to help users to understand the extent to which the financial statements are being impacted by that. And so that would be my suggestion for at least helping users to understand the extent to which the entity actually took advantage of the optional relief.
But just volume.
Yeah, just volume.
Okay. Jim? You want
So I guess, to me, so I'll start with contract modifications. The whole purpose of this was to get effectively a fast lane around what the accounting would have provided you in the first instance. So I don't want to put speed bumps or impediments or other things in the fast lane and saying, if you take the fast lane, we want you to show you what the accounting would have been had you not taken the fast lane or do extra tracking. Because I think what we're doing is telling people, in effect, we'll just go down the normal accounting and create your own internal expedients, and then you don't have to go through machinations to put in place internal controls that are subject to audit of, with and without calculations, or these are the contracts on this day that were modified. And so I think because we're just trying to provide, at least on modifications, a fast lane to get you where you would have been, and if we think we're not getting there, then that probably calls into question more sort of scope and other things. So I wouldn't do that. I think as a derivative, in the derivative space, some of the expedients are to get you where the accounting would have otherwise gotten you, and or suspend the necessity to calculate the impact of ineffectiveness created by SOFR, and we know that. That's why we're doing it. And so I'm hesitant to start then creating disclosures that are trying to get you back to this is the accounting you would have had we not provided expedients. And I think that's the path that to me this leads to. And so I'm comfortable with what we exposed. I think the input supports that. And so just broadly, I'm not in the same spot on disclosure.
You want to get back in?
Yeah, I just want to clarify, I wasn't talking about contract modifications, I was talking about hedge accounting, and my concern is that the accounting relief won't necessarily get us to where we would have been anyway, because the relief may allow hedge accounting to continue for hedging relationships that would otherwise have needed to be designated and may not be highly effective. So we are deviating from sort of our normal way of thinking about hedge accounting, that you only get hedge accounting if you're highly effective. And so that's my concern as to why I would like, and again, not tracking, this is what it would have looked like with, this is what it would have looked like without, just some information to help users understand to what extent an entity applied the relief to their hedging relationships.
Just a point of clarification. So that's for relationships that would otherwise be ineffective.
No.
The relief enables, because
all I'm asking, so presumably they know which, when they apply the accounting relief that we're providing, right? Presumably they know when they're doing that. So they already have to provide these volume disclosures. It would seem like they should be able to say, for these hedging relationships, we applied the relief. For these ones, we didn't. That's what I'm looking for. Or I'd be open to suggestions. It's just that a blanket statement that we applied relief because a hedge accounting reform, or because of reference rate reform, is not going to be overly useful without somebody being able to understand to what extent they actually applied it. Okay, and the ISB is looking at a disclosure that's not too different from this, right?
Yeah, so as part of as we understand it, as part of their phase 1, which they just completed, they have a disclosure requirement that to the extent that you're applying that phase 1 relief, that's being described in the hedge accounting footnote as to what hedging relationships you're using that relief for. The difference there is ISB is mandatory in that you can't voluntarily de-designate hedges. So theirs is a requirement. Ours is a series of optional expedients because you can always voluntarily de-designate. So there are some slight differences, but you're right. I think what you're describing is not too far from what the ISB has required.
Gary?
In this project, I think, you guys have done an excellent job in terms of, expediting the process. I think we voted essentially, board members have voted for every suggestion, recommendation you've made. So I think you've done a great job in that regard. So we've accounted for or accommodated what financial institutions need to do to make this a seamless transition. On the investor side or the user side, in terms of disclosures, the one disclosure we're proposing, when I go to paragraph 26, the generalist equity analyst indicated that the qualitative disclosures, such as management's plan and progress disclosure, would not be helpful to their analysis. So what we're proposing provides no decision useful information for investors. The way I think about it, leaving aside what-if scenarios, leaving aside forecasts, an analyst needs to know, when I'm looking at a bank, what is their exposure on both the asset and liability side of the balance sheet. Give me some information, because I don't know how the transition is going to work. It could go seamless, it could have trouble. A bank could have a positive impact, a neutral impact, a negative impact. But right now, I have no information to make that. I can't even think about it. I got to speculate, and therefore, to me, some disclosure around exposure to LIBOR rates on the asset and liability side of the balance sheet, to me, is the most important disclosure.
Okay, so what you're asking for is in question 11, you would like for more disclosures about the exposure to IBOR and then how they're managing their exposure. That's what you're asking for? Okay.
Some kind of percentage or range. It doesn't have to be 82.2%. It could be, more than 50%. It could be less than 25. I'm not hung up on specific things. I'm open to suggestions.
Okay. All right. Anything else on question 9? Anything on question 10? Question 10 being, does the board want to amend the guidance in the proposed update to add any of the relief application disclosures? Any concerns with what the staff's recommending in question 10?
Well, they're recommending none, so I've already, I talked about the two that I would
but
recommend.
any more?
No
Trying
more.
to figure out the whole
Yeah.
package here.
Yep.
Okay, so now with question 11, Gary, and I know at IAC, sorry, Sue. I was going to move to question 11. Okay, so I know Gary has raised some observations about what he would prefer that the board take on looking at, and we can discuss, do we want to do something, and if we want to do it, we want to do it in this project, separate project, but let's figure out with the population what we might want to consider. I know an individual sitting in Hal's seat yesterday at IAC had similar perspectives. Fair? Do other board members embrace what Gary is saying about the need to do that in the audited financial statements? Yeah. What? Go ahead. I mean, I'm trying to engage a debate. So you say yes. Marcia's probably gonna say something else.
Yeah, I was going to say, I think we already have some pretty good structure in especially talking about managing a product that's going to affect the future. That's what a lot of the risk related disclosures in the existing requirements at the SEC today are intended to cover. So I'll let Hal speak now.
Can I just jump in? I don't think this is a risk factor situation. I want to understand what the impact is on the company. We keep falling back to this risk factor.
Well, but you addressed exposure. So explaining where a company is significantly exposed, where their operations could be exposed, where there could be a change in their trends, in this case, the net interest margin in some of these financial institutions, that forward-looking conversation tends to be in the MD&A and in the risk factors, because that's where there's a structure that allows people to talk about the future, not in the audited financial statements.
Go ahead.
Wow, a couple different points. First of all, these exposures exist today. They're not future exposures. They're exposures that exist today. They're represented on the balance sheet today. And I think Sue hit the nail on the head early on. She said, we're doing this because there are a large volume of transactions, not because we don't have a mechanism for modifications. We have a large volume of modifications that are coming, big dollars that are affecting real cash flows. This isn't, a timing issue. It's real cash flows that will be changed. Yet we're not proposing any quantitative disclosures, right? Now, I can go on and on about how I would use information and how I would use the exposures, but let me just briefly state that if you pull out at least financial institution financial statements, you already have a tremendous amount of information about the balance sheets and the assets, the liabilities. You understand what is at fixed rates and what is at variable rates. What you don't know, and what I'm consistently now hearing from investors, is that, we really want to understand of the variable rate, how much is going to have to get renegotiated? What is the impact on margins, both the interest income, the interest expense, and how does this whole thing tie together? They haven't spent a lot of time focused on it yet at the conferences I've been to. They're so busy focused on CECL today because that's the next in line for them to worry about. But in terms of the next big issue where they're going to really look for a lot of information and really struggle, this is it. And I think they're going to struggle far more with this issue than they do with CECL. And CECL is going to be a significant step forward for them because of the amount of volume of information, disclosures that are going to be provided ultimately. Here, none, and I think it's just going to raise more and more questions. So we can talk about, why certain things may be in and what you're doing is qualitative, and that's all good, but it's not getting to the heart of the matter at this point.
So I'm going to go back to what you said that they're looking for. Make sure I fully understood everything. They're looking to understand the exposure.
My personal belief is that the first and foremost issue they're going to wrestle with is exposure.
Exposure, okay. And then you think they're going to want to understand how that exposure is being managed. I mean, what is the change in status of all of these things need to be changed?
Exactly. And what I think of this as a management approach, because internally, and this was confirmed at FASAC and at other meetings we've had, is that they are internally working to build or either build or have project teams already in place that are tracking their exposures, and think of it as a to-do list. They're going through each portfolio and saying, yep, here's where we are this quarter, this quarter, this quarter. So this is not a heavy lift from an understanding exposures. It's how to communicate what they're already doing internally to the external world.
But then you said something like impact on margins.
Yeah, because this is going to affect real cash flows,
right,
which in turn translate into interest income or interest expense.
Yeah. But do you think that's something management should be required to disclose, the impact on margins?
I think that the first is far more important than the second. I think the second will become more transparent, and I think that there may be some mechanisms already in place to have that discussion.
When you say, I had three things. You said first and second, you confused. So when you're saying second, you mean impact on margin?
I think that is an important thing, but I think that there are already mechanisms in place for that to become more transparent. Could we help with that? I think that's worth having a discussion, but exposure is what's needed right now.
Okay. Go ahead.
So one of the things that I heard in the discussion with the IAC yesterday, I think the person who was sitting in your seat made the comment that the breakdown between fixed and variable for assets and liabilities is useful, but that they had been asking for years, as he put it, for a more granular breakdown on the variable side, by which ones are pegged to LIBOR, which ones are pegged to prime, which ones are pegged to whatever. So is that one of the things that you would recommend, that we should just make that breakdown more granular?
Yeah, because you already have some of that breakdown, like was discussed, between fixed and variable. What has always been missing is, of the variable, how
Right.
much is tied to prime, how much is tied to LIBOR, different types of LIBOR, IBOR, we can go on and on here. Because each of those interest rates can act differently, and because they're using that information today to assess impact on margins, interest income, interest expense, they're flying blind in large part. Now with this transition, that need for that segregation becomes even more important, particularly for the next few years.
Okay, and that disclosure is required in audited financial statements today, the fixed variable split. That's not in MD&A, that's in the audited financial statements?
No, the average balance sheet is a Guide 3 disclosure today, but there, in addition to Guide 3, things that are available in the audited financials of breaking those assets down by maturity class.
Okay.
And it would also tie in with the vintage disclosures and other areas where you're breaking down the loan portfolio.
Okay.
So all this is helping me understand what's my interest rate, interest income and expense, and
different characteristics of things that are reported in the balance
already
sheet.
reported, correct.
Just a clarification, Hal. Help me understand. You made a reference to impact on margin. So I'm trying to understand exactly what we're talking about. Are we talking about, take, for example, a simple loan. Obviously, we're talking about consolidated basis, and it may have 10 more years to run after the reference rate is changed. Are you talking about trying to come up with some either direction or quantified number as to, well, the new interest rate compared to if LIBOR had not changed, the difference would be this? I'm trying to understand how impacts on future margins would be calculated when you're moving from a variable number to start with.
We can spend a couple hours talking about the analysis, but let me just
short answer.
Let me give you the short answer, all right? I'm looking at one bank's disclosures. These exist today, okay? And let's just take two line items, the commercial loans and the residential mortgage loans, two very different animals. The commercial loans, if you told me everything was tied to LIBOR and commercial, my analysis would be pretty quick. It would be, most of that is going to turn over between now and when LIBOR disappears. I'm going to have an opportunity to renegotiate those. May have some impact on margins, but relatively minor. I'm going to push that off to the side. I probably have a few questions for management. Okay? Now, if I go down to the residential mortgage line, much longer tail. I don't at this point know. I may know what's variable. It wasn't clear in this particular disclosure, but I may know what's variable, but I have no idea what is tied to LIBOR. I would want to know of that LIBOR, what is variable, how much is LIBOR, how much is, say, prime, right? And if it's the fallback is to prime, that's going to have a tremendous impact on several things, including, in my view, collectability of those loans. Because if you have a big jump from a LIBOR rate to a higher prime rate, I think, guys, it's 200-300 basis points, that could have a tremendous impact on the collectability of that particular segment.
So it sounds to me like what you're looking for is less quantitative and qualitative disclosure.
No, just opposite. I'm looking for some quantitative. The first starting point is, what is my exposure to this change?
Right. So if you have better descriptions, you can make your own judgment as a user as to what could happen.
If you come back and tell me in this example, if you tell me that there is exposure to this issue, I probably already know that because I'm already reading it. I've already read it in newspapers. I've been to conferences. I know that the bank has exposure here. Right? Now the question is, in this particular example, they gave a percentage of the total loan portfolio that was exposed to LIBOR and reference rate reform. Interesting, but not usable, because you need that information on a more granular loan type by loan type. Right? And then from there, there's additional pieces of information that would need it. But at a starting point, telling me that there's a risk out there is not very helpful.
So the staff had put in our memo on disclosures a SEC staff statement. The statement talks about a lot of the things that you seem to be talking about under the section of Division of Corporation Finance. Do you think that this doesn't go far enough, or are you?
I question the timing of when that information is going to be available, and I'm concerned given.
What is that?
How do I say that fairly?
Yeah.
There's been less information provided about the CECL transition than investors need and want at this point in time, and so if we're relying on that as a model for future disclosures in other areas, I would question whether or not that'll be timely enough for investors to gain the benefit.
But this is actually like relevant today. By the time we got done, it would be relevant. I mean, at least 6 months from now. So wouldn't this?
Well, question 11 is, do we want to do this as a separate project?
That's longer.
Right. So I mean, so if we were to say yes to that, probably minimum would be 6 months. The SEC's public statement went out like a few months ago.
I appreciate that.
Relevant.
And find all these disclosures that are going to help me understand.
Okay. All right. So go ahead, Jim.
So it sounds like, in part, the project would be encompassing not just anything to do with rate reform, but it's interest exposure project. If you want to know how much is exposed to prime, how much, because if it's exposed to SOFR today and it was never exposed to prime, I don't know why that would be a different loan for your analysis going forward, because the loan shares the same exposure.
It's always been needed. It's needed even more today because of existing disclosures. And the board collectively has made a decision not to address this issue in the past. 4, 5, 6 years ago, we had projects that would have looked at interest rate risk exposure. And we didn't go down that path for various reasons. But here, because we're charged, as you well know, with the responsibility of understanding the environment and changes in the environment and what impact that has on financial reporting, I can't think of a more classic example of where the board should act and act quickly.
And I just happen to be in a different spot than that. I think we already have a dynamic system of financial reporting that responds to risks. That involves risk exposure as one aspect in the financial state, or in the 10K package. It involves MD&A for existing exposures. That's the disclosure Russ talks about. I don't think CECL is necessarily a good analogy, because SAB 74 is only required to the extent that you've already calculated and know it. The other risk disclosures are not the same threshold as SAB 74. Now, of course, that's subject to materiality, and so if it's not material, but I think that's where risk exposures ought to go. And if I recall, at FASAC, there were investors, one sitting in about this seat, that set up the top 10 risks he would be interested in. This would just associated with interest rates. This wouldn't fall in the top 10, and I could understand why, because the objective here is to take one high credit quality rate and move it to a more secure, less subject to manipulation, less subject to uncertainty. I get that may not be perfect. We've seen beginnings of SOFR that may cause people to be more apprehensive about moving, but the objective isn't to have wide variability in cash flows, and I think that's why entities are looking at that, all of the things they're exposed to.
I appreciate,
this isn't probably that high on their list, and to me it doesn't necessitate then us saying this is the risk exposure. There are plenty of other risk exposures in the system right now that we don't have separate projects on. The nature of this project was facilitating that change. So I never felt like the financial reporting system, as it relates to reporting and identifying risk, and giving information about that was broken.
Yeah. And I appreciate all the comments that you made. I'd point out that that particular individual I think you're referring to focused more on non-financials instead of financials. And I think for non-financials, I think the exposure is pretty minimal. There'll be some impact, but I think it'll be minimal and also largely discernible from the disclosures that are provided today, because most of their risk is on the right-hand side of the balance sheet, not the left. But for the 20% of stocks out there, equities, and I think Gary pointed out correctly, this is more for equity analysts, though. When I've talked to the fixed income analysts, they also are very interested in this because they think it does have some impact on their thought process, but let's focus only on equity analysts. For the equity analysts that follow that 20% of the marketplace, this is going to be a major, major issue, and they're getting zero, not some disclosure, zero disclosures.
Can I just ask a question? How could I do an SEC risk factor analysis or a materiality analysis with not understanding my exposure?
Who are you, an
How could a
investor
company,
or a
how could a
company?
bank, how could any bank do their SEC risk factor disclosures or any kind of accounting materiality disclosure without evaluating the quantitative nature of the risk of the asset and liability of the balance sheet? They have to do it to do these, correct?
Yeah.
I mean,
The game was suggesting they don't.
that's right.
What we're trying to figure out is what is the incremental value from us doing a disclosure that appears to already exist in the existing requirements.
And our point is then, once they've done that analysis, disclose it to us. That's our point of view.
No, you're missing the point. If we what I hear you asking for is what is in the SEC's public statement. If we literally put that in ours, why would there be a different outcome? To me, what we ought to do is, if you're concerned that, in other words, if you look at what's in the Division of Corporation Finance SEC public statement, and you think that is getting you basically what you want, but when you're seeing it, it's not there, then to me, that's a different data point. It's not about standard setting, it's about better understanding why that's not being disclosed. It may be that management doesn't think it's material. I don't know.
There's also a question about timing and location, because certainly some elements, like as described in paragraph 62, sharing information used by management and the board in assessing and monitoring how transitioning from LIBOR to an alternative reference rate may affect the company. And because that's forward-looking information, having it in the fore part of the document affords them some safe harbor if they get it wrong.
Oh, I'm not. They want to add the disclosure because it's already required, but they want to move it to where it's.
Well, that's what
actually
so what I'm saying is that some of that information may be forward-looking, so it doesn't actually belong in the financial statements.
And that's why I'm being very careful here not to ask for any forward-looking information.
I'm responding to Gary.
Okay.
That's my point too. I have no, forecasts, what-if scenarios is not part of what I'm talking about.
Okay, but
talking about simple exposures at a point in time.
Okay, so let's hear from Christine. Let's talk about way to path forward here. Go ahead.
So I just wondered if you were envisioning this information being important only to public companies, or if it would also be information that would be important to private entities, because that if it's also important for investors in private entities, then that's not going to get picked up in MD&A. If it's only public, then I think having that discussion about MD&A is more relevant to me.
Clearly, this is a pervasive issue, public and private. The degree to which it affects both will vary depending on what type of entity they are, and not whether they're large or small.
Okay, but you wouldn't propose these disclosures only for public companies?
No,
And yeah,
would not.
okay.
And I think that's where I differ a little bit, because as I think about the disclosures and what's already required by SK, either through MD&A and risk factors, for private companies, looking at the private company decision-making framework, I think given the cost and complexity associated with these things, I think it would direct you in a different way, and it would provide enough information such that somebody could ask questions about the exposures if they wanted to. But, that also is predicated on relevance, and I don't think that we've done a ton of work with private companies on relevance, so we'd have to get our arms around that.
So here's how I summarize our discussions on disclosures. It seems like there are 3 different types of disclosure improvements that individual board members have asked for. 2 of those seem like they are relevant to this project, and 1 seems like it is broader than the project. And the reason I say that is Christine had earlier talked about, with respect to the basis adjustment immediately in earnings, that is derived from doing optional relief, which we're allowing for, and we can discuss do we want to do that or not. with respect to Christine's point about the staff's view of what is the disclosure relief, no objection to that, but then the amount of volume. Again, that's based on the disclosure relief. The discussion about exposure, I'm presuming you would find that relevant whether someone took the optional relief or not.
Yes, because they are exposed to a change in the rate, a contractual change to the rate. They will be exposed to that for the next 2 to 3 years until that is resolved.
And they may be managing that without taking the optional relief.
Exactly.
Right. So let's first focus on what we want to do associated with question 5 and question 9. Get that done. That'll be our package for this standard. And then we'll talk about what are some alternatives we can do associated with the discussion that we've had regarding exposure. Is that fair to isolate it?
Mm-hmm. By isolating, if you mean spin it off into a separate project?
Yes. Well, the staff's recommendation is spin off, but
I understand that, which I object to.
Okay. Okay, that's fine. That's fine. I
just understand that though. If we don't spin it off, I think if we added a different package, that presumably would call for re-exposure, so we wouldn't finalize this.
Which is the reason why we asked the question in the exposure draft. I pointed that out.
We can go back and listen to the minutes, but the reason was whether we should add a separate project associated with. I think we're very clear about that.
I understand that's the way it was worded, but my request was to include it as part of this project.
So I'm happy to have a discussion about what we want to do associated with that before calling a final vote. I'm happy to do that. So let me just focus on 5, 9, and then we'll go to 11. Okay. Those are the questions in the board handout for those that didn't know what I was talking about. Okay, so if we rewind maybe an hour with respect to question 5,
ABC,
and this had to do with the immediate recognition of the basis adjustment, where view A was to affirm no explicit disclosure, view B was to require explicit disclosure of the total amount of the basis adjustment recognized in earnings. And view C was to disclose the amount that was embedded, that was in earnings, that was related to the actual transfer from LIBOR to SOFR from one reference rate to the other.
Can I just?
Yeah.
I just want to be as specific as possible when it comes to the difference between B and C. When we talk about the total amount that goes to the income statement, it's the basis adjustment for hedges that are related to LIBOR, which you could have other hedges that aren't related to LIBOR, and that would be included as a P&L, right? So I look at this as I have a total basis adjustment that includes all hedges, right? That's a requirement today. View B would then take that total amount, separate out those that are just LIBOR related, and disclose that separately. And then view C would say, okay, of that subset, what's the subset that is the impact of just changing LIBOR to SOFR? I just want everybody to be clear about that, because view B isn't, because there's been a couple of discussions about view B being the same disclosure. It's not, because you could have other hedges that you need to separate those that are LIBOR related.
No, what I was saying by view being the same is the view B disclosure, in my opinion, would equal the amount associated with that instrument in the journal entry report versus C is not.
That's as long as we're clear.
If you had view B and then you had a view B prime, which is all other, you'd add up B and B prime and it'd equal what you put in. C is not going to be tied to your books and records because it's some other calculation.
That's exactly correct. I just want to make that clear, because today we're not disclosing basis adjustment due to GBP, basis adjustment due to LIBOR, basis adjustment, and B would do that effectively for LIBOR, although you're calculating it,
Would view B do that as it relates to LIBOR, but only for those modified during the period?
Yes.
Okay, so it's not all LIBOR. It's even a further subset than you said.
That's right.
There would be some associated with LIBOR that continue, perhaps, and others that were modified, and it would be those.
Yeah, and then C would be a subset of that subset.
And it's just all of the basis adjustment associated with that instrument that hit earnings in the period. That's view B. Amortization.
Correct.
Yeah. Okay, so let's see where we are. See if anyone changed their mind. View A. View B. View C. Okay. All right. To move it along, I will change my vote to View A so we can have a conclusion on that. Okay, with respect to question 9, the staff was recommending, I refer to this simply as the what, which is that you adopted the transition relief. Does anyone have any concerns with the what? We're going to add to it. Don't worry, because the way I phrased it, I could see you going, "Hey, wait a minute, you forgot my point. You forgot my whole." Okay. So then the question. Okay. So basically, view A will be just the what, which is the staff's recommendation. View B is going to be an additional volume disclosure related to all contracts, and view C would be an additional volume disclosure related to just hedges. And when I say all, I mean all contracts that had accepted some relief. So that would be your debt instruments, whereas view B would be just your hedges.
So
C, sorry.
C is just hedges, so.
Okay, hold on, I will in a second.
So I'm just trying to understand, if I modify the hedge, it would be in. If I modify the cash instrument, it's out.
That would be C.
Okay.
Yeah. So in other words, everyone agrees with the, I had the ability to do optional relief, I took it. That's kind of the, that's the minimum. Everyone agrees with that. Then the question is from a volume, so you understand exactly where you took, or at least directionally where you took it. We could say, I took it on 50% of my hedges and 30% of my cash instruments. Or view C would be, I just took it on X amount of my hedges, and there's only be hedges. And the reason I'm drawing a distinction is because I think when Christine originally proposed this, we thought it was all, but then she clarified it for just hedges. Right?
So hedges kind of talks about the entire hedges, cash instruments, everything related to hedges.
I think she meant just derivative. I think she said just derivatives.
She meant, yeah.
Not the cash instrument.
But in the context of this project, which is focused on practical expedience, B would be in association with just the practical expedience, or just would it be the volume of all your exposures?
I assumed it was just the ones you chose to have relief. So if you had 10 derivatives, and you took it on 4, you would describe. View A would say, I took some relief. View C would say, I took it on 4 of my, right? That's what you're proposing?
Yeah.
And just so I'm clear from our perspective, Christine, you're envisioning, so I've got a table that says, here's the amount of notional that's in a fair value hedge, and of that notional amount, X notional amount, I applied a practical expedient. Is that what you're envisioning, or is it something different?
Would be building off of the volume-related disclosures that are already required in 1A and 1B, okay, of topic 815, 1050. And entities are permitted to select the most appropriate form and content for that volume. So
yeah, I'm just giving notional as an example.
Okay,
just as
I was going to say, I'm not going to require.
I'm not suggesting you would require notional.
Notional.
I'm just saying if you've chosen notional, you would say notional amounts in a fair value hedge are X. Of that notional amount, I've selected practical expedience for this notional.
Right.
So the way to
if you use notional.
Right.
The way to really phrase it is, within the existing derivative disclosures, if you take an optional relief, within your existing disclosure table, you need to highlight which ones you took it for.
Yes.
Or on a volume basis.
Right.
That's C, right?
That is C. Yeah. Good. No one wanted me to repeat that. Okay. Who supports view A? Be quiet. View A. View B. You want B? And view C. Well, I'm gonna.
I
gotta
thought
four,
view
so
B.
I guess I'll vote.
View B in my mind only gives you part of the picture. That's why I think if you're kind of getting at it, view B to look at the overall volume of exposure, it shows you what you took the practical expedient about, but it doesn't actually, in my mind, provide you the big picture.
Yeah,
See, yeah.
well, the problem is that the solution to that is not to give them nothing,
But
which is
that's
what
why
we're doing.
I voted the way I voted, I guess.
You voted for A.
So vote on 11 to require exposures.
All right, so I'll, to make 4, I'll go with view A. Okay, now with respect to the question 11, which is do we want to have, I think I'll alter question 11 slightly. So question 11 is really about do we want to add a separate project related to exposure. I know that separate project would frustrate you, right?
Just a little, yes.
Just a little. Here's where I am in this. I don't see a need to have an incremental disclosure requirement in U.S. GAAP for the audit financial statements when it seems to me what we're talking about we think investors need is already referenced to and appears to be required in existing SEC guidance. So my question is, do you agree with that statement? Because there's a difference between
I agree conceptually that could help the situation. Unfortunately, I've yet to see any benefit from that. So you're basically asking me to vote to not require in GAAP and roll the dice that at some point in the future, some institutions will provide the information.
So,
and that leaves me very concerned about, and again, I go back to the volume that we've talked about, the pervasiveness of the issue, the tight timeframes that we're talking about, the flexibility that we've allowed for, and the true impact on cash flows, and we're not going to require in GAAP anything. That troubles me.
So, I agree with that. Okay, but what I was trying to get at is if you think it's already required, and that's is why.
I appreciate that is what Corp Fin has said.
Okay. Yes. It seems like there may be other more efficient paths to help people understand that this information needs to be provided to users than us going through a process. And if it's already required, so my proposal would be is why don't we call a final vote based on our decisions as written, and have a dialogue as part of our regularly dialogue with the SEC about the importance of this information, and see if there's ways to continue to promote the awareness that this information is important to investors and appears to be required. And you may view that the way to emphasize that could be a dissent. I won't reject that. I'm just saying that it seems to me that if we think it's currently required and people aren't doing it, there may be valid reasons why they're not doing that. That's just my proposal to move this forward today. The other alternative would be, and I'm happy to call a vote to say who wants to include this in the document, and if the vote is to not, you can just.
I have always thought that was first and foremost what this project should be about. So
why don't I call a vote as to who wants to add within this project? I can do a vote of who wants to add within this project required disclosures about the exposure to reference rate reform. And if there isn't sufficient and wants to include this, I can talk about is there sufficient appetite in the board to look at other paths, including dialogue with the SEC. Is that fair? Okay. So who wants to add within this project required disclosures about exposure to reference rate reform, as well as the management of that?
Quantitative disclosure.
Quantitative disclosure, as well as I have my notes change in status. What you mean the management of that? So
that would change because you'd be providing the quantitative over time.
Okay. So who wants to add that to this? 3. Okay. So 4 of us do not. Okay. So people are okay giving me and perhaps at least 2 of the 3. I can't have all 3 but to privately have discussion with others about how to encourage this and get the awareness out. Okay. Great. I told you we wouldn't be done by 11:30, Kip. Okay. Anything before I move on to questions 12 or 13? Anything else from the staff's perspective? Okay, Alexia looks like she's ready to tee it up, so go for it.
Yep. Questions 12 and 13 relate to costs and benefits as well as the permission to ballot, and those questions will be teed up together. The staff continues to believe that the benefits of the proposed relief are justified. The staff notes that the relief is temporary and elective in nature, and generally would not require entities to make significant changes to their financial reporting systems. If the board grants the staff permission to proceed to draft a final update for vote by written ballot, the goal is to issue a final update in the first quarter of 2020. The questions for the board are as follows. Question 12. Does the board think that the expected benefits of the changes would justify the expected costs of the changes? If not, is there additional information that the board needs to make that determination? And question 13. Does the board give the staff permission to draft a final update for vote by written ballot? I will now turn it over to the board to discuss questions 12 and 13.
Okay, any additional information, any more debate, views when we heard? Okay. Okay, who at this point believes the expected benefits of change justify the costs and will be voting to affirm this final issue? 4. Okay, and the 3 not, the basis is,
There's a cost-effective solution for what is going to be a pervasive problem for investors, and we're doing nothing to help that process.
Okay. Yeah.
My basis for dissenting is that I think we're doing a lot of optional relief. I think it's a good thing that we're doing that. I think that decision, it was then on us to make sure that we provided some information to help users understand the extent to which that optional relief is potentially impacting a company's financial statements, and where there's numbers that are going to be buried in the financial statements that they would want to know, that we should at least try to help them to have some transparency around that information. So my feeling is that we're not meeting the objective of financial reporting with this guidance.
I agree. I mean, I think the team has done a great job, working on an expeditious basis. We've, made it as easy as possible for folks to transfer it from LIBOR to SOFR. So I think everybody, all 7 of us agree on that completely. In the camp of providing information for users that enable me to understand what is going on here, our proposal really provides limited information that doesn't help you in analyzing the situation. So therefore, I think we need to go beyond that to provide some disclosure related to exposures to that.
Okay. All right. Great. So pursuant to our policy, we will need the dissent. I don't know if it's one dissent signed by all 3 of you, if there's tweaks to it, but technically we're going to only need that before we do the final ballot. So I would like to go to a pre-ballot first, if that's okay with the team. We can all do that and then ask, have you read the pre-ballot, then to produce your dissent, because we have to, I've made that mistake before, not having the ballot in. We've had to reballot, so we don't want to do that here. Okay, anything else on this project? Any other projects? Okay, great, thanks. We're adjourned for the day.